401k.com.
We've been talking about it. We've been planning for it. We're in 2015, and that means we're just, I guess, a few days older, but we're past another year. That's why we've got Chris Everett on the show. Chris Everett from Everett Wealth Solutions joining us to kick off the year to hopefully make better financial decisions. Chris, welcome to the show. What advice do you have for us today?
Well, Happy New Year, Shalom. Thanks for having me on today. It's all about financial balance. When you think about going into your new year, what are you really thinking about in terms of getting to financial balance? So by that I mean, it's one thing to put money away into your 401k plan, and you absolutely should be doing that. Do it up to your employer match. Once you hit that employer match, please save outside of your 401k plan and put money into a place where you can have liquidity, use, and control over that money. You'd be surprised how many people get into financial imbalance or turmoil or, can I say, financial hell, simply because they have too much money outside of where they can easily access it. And then they'll go into interrupting the compounding into their 401k when they get into trouble. One of the worst things that you can do is interrupt the incredible compounding that can happen inside of your 401k or any financial asset for that matter. Does that make sense to you?
It does, and that hopefully will be many of our listeners' New Year's resolution as they kick off 2015. It's another year, and there's probably many opportunities now for employees to talk to their employers about what plans might be available and what options they have. And in my opinion, if there's a plan available, it's free money, and if you're able to get an employer match. Chris, what do you think?
Absolutely, and that's why I say put money into your 401k up to the employer match so you don't leave any money on the table. But please do not discount liquidity, use, and control of your money. Now, for those of you that have a 401k, find out if your employer is offering a Roth option. And by diverting all of your contribution into a Roth 401k, you won't get any tax deduction. But keep in mind, if your employer is doing a match, they'll be doing so on a pre-tax basis. So if you're just starting your career and you put all of your contributions into a Roth, knowing that the equal amount is going into a pre-tax regular 401k, when you get out to retirement, you'll have pots, some that will already have been taxed and some that will not be. So it gives you some choice. It gives you some flexibility when you get out to retirement. Think of it this way. There are many people retiring today, and all of their money is in a pre-tax plan. They have no options. So every resource that they have for retirement is going to be a taxable resource. So it's all about financial balance.
It sure is. And many employees that might be listening to the show, again, there might be a partially employer-funded plan. How involved do you think people should be in looking into where is the investment going? What possible outcomes will there be? Or do you suggest people sort of go with the flow and let it happen on its own?
Well, I'm not going to say that. You really should take a look at your money. Now, there are many tools that help you to kind of stay a distance if you're not someone who can actually look at it all the time. There's many targeted retirement funds. So if you're going to be retiring in 20, 30, 40, 50, 55, whatever it is, you can choose a targeted retirement fund that does a lot of the money management for you. So that's something to consider. And whether you're putting the money into a Roth 401k or a traditional 401k, you have the same investment choices, typically.
Chris, many of our listeners might not be familiar with what is a Roth IRA. Does your website have that information, sort of dictionary of sorts, to help demystify the process?
Absolutely does. That's EverettWealthSolutions.com. And there's plenty of resources there. There's money school videos. There's an entire arsenal, library, if you will, of information on all of these accounts. But simply said, a Roth IRA means that you're not taking any tax deduction. You're saving the money on an after-tax basis, just like you would put money in a savings account. But if you put it into a Roth IRA, as the account grows over time, as long as it's been in there for 5 years, when you go to take it out, the money can come out tax-free. So you could really be building a large arsenal for yourself over time, but don't interrupt those savings. Whether it's Roth IRA, Roth 401k, or 401k, allow the money to grow. Do anything else but interrupting the flow of the compounding. And it could be hundreds of thousands of dollars to you over your lifetime.
Well, many of our listeners, again, are not that familiar with the process, and that's why you need to talk to a professional at Everett Wealth Solutions. Get Down to Business is brought to you in part by Everett Wealth Solutions. Our good friend Chris Everett, you just heard from her. She's a registered investment advisor and financial planning firm, a fiduciary advisor that helps you create your personal wealth. Chris, what's that website again?
EverettWealthSolutions.com.
And your phone number?
708-771-7777.
That's the easiest phone number, 708-771-7777. So don't let the phone number be an excuse for not calling Everett Wealth Solutions. That number, 708-771-7777. Chris, thanks for joining us and Get Down to Business, and Happy New Year to you.
Happy New Year.
After the break, we're talking with Chaim Shapiro with advice on how you can improve your LinkedIn profile. You won't want to miss this segment. You're listening to Get Down to Business.